Hi, this is Nilus Mattive from Money Markets TV. I hate to remind you, but tax day is only a month away. So today, I want to talk about the tax issues related to one of my main areas of expertise, dividend payments. The good news is that qualified dividend payments will continue to receive favorable tax treatment through this year, thanks to the 2010 Tax Relief Act. For most investors, that means you'll pay about 15%, typically much lower than your ordinary income rate. But what exactly are qualified dividends? Well, they include most of the payments you receive from common stock, and that's usually specified in the 1099 statements from your broker. But there are other types of investments that do not get favorable treatment on tax day. These include real estate investment trusts, or REITs. REIT dividends are treated as ordinary income because these companies generally do not pay taxes at the corporate level. Instead, they dole out most of their income to their investors in the form of dividends. This is why their yields are often much higher than other investments, and also why Uncle Sam wants as much of those dividend payments as possible. Given the poor recent performance of many REITs, that's like pouring salt in the wound. As far as preferred stock dividends, only so-called traditional preferred stocks qualify for the 15% tax rate. In contrast, any income from trust preferred shares will be taxed at your ordinary income rate. That's because they're technically considered debt securities. Meanwhile, you also have to keep an eye on your mutual fund dividend payments. A lot of funds use the term dividend to denote all kinds of payments, including regular old interest. But the same basic rules apply. Dividends from common stocks will usually get taxed at the qualified rate, most other dividends will be treated as ordinary income, and long-term capital gains will be treated as such. The tax statement sent by your fund company or brokerage should break the categories up for you. And then there are payouts from master limited partnerships. They're in a special category because an MLP's income is treated as if it is earned by the partners, meaning the shareholders. These payments may look like plain dividends, but the bulk of the quarterly distributions are considered a return of capital and not taxable investment income. That means most of the payouts are tax deferred. Whichever kind of dividends you receive, reinvesting them is a smart strategy, but it makes things much more complicated as far as Uncle Sam is concerned. That's because the IRS doesn't allow you to just figure out an average cost basis for all the shares you've bought over time. Instead, you have to determine the actual price paid for each purchase. That makes saving your account statements very important when it comes to determining your cost basis. And the longer you practice dividend reinvestment, the more complicated things will become. If all of this stuff is making your head spin, there's one way to avoid most of the madness. Do your investing inside a tax shelter. I'll profile some of your best options over the next couple weeks. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.